Hi everyone, welcome to part 2 of Ross Haber's interview. In this one, we talk about MarketSmith and how Ross uses it to keep track of leadership and track rotation. And Ross will also share his screens that he uses every single day to help find the next big winner. So I hope you enjoy, and if you do, please go ahead and leave a like down below and subscribe if you're new to the channel. And here we go. Walk me through kind of where you're looking at first, what things you're looking for, whether it's fund ownership, earnings, the actual price action.
Gotcha.
So walk me through a chart here.
All right, so normally we've got this up here. So earning, when I'm screening, what the first thing that's going to catch my eye is what a chart looks like, right? So once I see what a chart looks like, my eyes immediately drop down to the fundamentals, which are right here down at the bottom. So we can see the acceleration from negative to a slight pickup in growth for which quarter was that? 10% versus 1. So we've got the huge acceleration going, not only, and so we've gone from negative double digit to solid triple digit growth. Now sales, I look at the sales we're picking up. I'm not a huge fundamental guy. I'd be a lot happier not to see the 5% decline in sales. That obviously, that makes me wonder how they were able to grow earnings, and I don't know if it was a one-time thing. That's where I have to call one of my fundamental buddies and say, hey, I got a question for you. What's going on here? How do we get the 300% quarter? But that definitely, it would be something that I look at, but it's far from the end of the world. Then I immediately go up to our annual, and we can see we've gone from losing a lot of money, making a little bit of money in 2019, and the estimates for 2020. I mean, 999% is there because that's as high as it goes. And, Bill has made it very clear that those estimates are typically conservative. So that tells me that that also tells me that whatever that 5% is right there, that minus 5% is probably going to go away moving forward. Just looking at those estimates, I mean, 50% growth, and considering that, 48% for 2021, and keeping in mind that that's been revised down a bit, I guess. That's still huge for an annual growth for such a big company, especially after. So I look at it, I keep that in mind. Bill doesn't talk about estimates, but when I see the huge estimates, I would, go ahead. So those are the first things I look at. And you'll see here, return on equity. Bill talks about you want to see at least 17%. Some people keep the PE down there. I don't care about what the price earnings is so much. So that's the reason I keep that down there. Then we move over to the right, institutional sponsorship. But I like to see, and here we've got it, where you're seeing sponsorship pick up from the June 19 quarter, right? For slightly from 1,052 to 1,060 and on up to where we are now. And this is one of the newer features added to MarketSmith that I love, because you used to have to do it manually. Is not only do we see that the institutions, the big funds, insurance companies, trusts, what have you, are increasing their positions, you can see the quality. So if you really want to, we can look at the fund ownership and sort through and look at the quality of all of the owners. But what MarketSmith now does is, you can see here, these are what they consider flagship funds, or funds that, and I'm pretty sure you know this because you use the software as well, those are your top-notch mutual funds. And Bill used to stress that, yes, it's great to know that the institutions are the majority of the market. They drive the market. They're at least 70% of the volume. So the idea is to ride their coattails.
And let me ask you a question here, Ross. So how many of these, when you're looking at a stock, how many of these funds you like to see, or do you not really have a number? And it's okay, actually, if there's none of these funds in here at all.
Listen, I'll tell you that ever since I've had that feature automatically show up there, I'm not going to lie. I mean, I love to see the big list. For example, here, let me change the chart. I know off the top of my head, I think TTD's got, as you can see, big ownership. I've had a close eye on that one. You can see ownership not only been, it looks like, what do we got it increasing every quarter for the last 8 quarters, and you've got some, you've got quite a bit of high quality ownership in there. So I really don't, and I know some people will tell you, you want to know how much institutional ownership is too much. I would say that while I look at that and I might use that I would use that as a secondary indicator along with price volume. Like one of those, like we're suddenly starting to see splits again, which is going to be great for the first 2 or 3. And then, excessive splits is another one of those things that is usually a sign that things are getting frothy. But, it doesn't worry me that we've watched them go from, over the last 8 quarters from 432 to 766. That could easily double again over the next 2 years. And the more important thing is that you've got solid positions from, half a dozen super high quality funds in there. So not only do you have institutions loading up on the stock, but you've got some really smart, successful funds. I was trying to explain this to a friend the other day. He was showing me a stock. He's like, doesn't BlackRock own it? And BlackRock's great. And BlackRock is great. It's a great firm. However, we all know that no matter how great a firm is, whether it's the biggest, you're the biggest on the planet like BlackRock and Fidelity, not all of their fund managers are the best. So just because a fund owns your stock, it doesn't necessarily, you've got, it needs to be looked at carefully. And I love MarketSmith makes it very easy. It puts it plain and simple there for you. So those are your slim fundamentals. That's the first thing I look at. And as long as all of that is more or less intact, I will, for example, let a quarter of sales go as long as, X, Y, and Z are all intact. And we're talking about a leading company that's changing the way, the way we work, the way we live, the way we communicate. As long as it's one of those with a legitimate story where growth really seems like it can continue, then I will be forgiving of a quarter here or what have you.
Let me ask you here. So I see you've got some favorite screens on here. Could you kind of walk through each one and kind of tell us how you use each one?
Absolutely. I'll be honest. The China screen is literally just all of I went through and clicked, show me only the stocks in China. So that way, and here we can run it. It'll pull up all the stocks in China, or with headquarters in China. And then I typically like to sort things. So here we go. The China, we've got 229 stocks. First way I'll typically sort things, and you can see I have it automatically sorted that way by relative strength. Now, the problem with doing that is you're going to get a lot of low-priced, garbagey stuff. But because you can hit spacebar and flip through them so quickly, when I see the low-priced, so I'm hitting spacebar now, and but this is what I'll do. And you can see I've got an alert here that needs to be reset. Now there's no real entry on NIO. I'll look at it and say, oh, okay, we're getting support at its 10-day moving average on a relative, given the damage to the market today, this thing's holding up like a champ. So I'll keep an eye on it. And so what I'll do, their electric vehicles are almost their own group now. So we've got NIO and whatever we've got, right? BLNK, which is the charging stations, Tesla, Nikola. So I watch all those stocks, even the garbagey ones, because I just want to know what the group is doing. So what I'll often do is, just because I want to know what it's doing, I don't really care if it breaks the 10-day. I'm not looking to buy this one, but if it were, maybe, if this was something I was interested in, maybe I'd look for it to undercut, somewhere down here to 1644. But I'll typically just draw an alert line, set an alert somewhere, and if it goes lower, eventually when I'm going through all of my stocks, I'll catch it. But anyway, so this is what I'm doing. And I go to the next one. There's obviously, this stock was doing great. You can see where I had the alert, obviously, no good anymore. But look at those earnings, sales, and return on equity, right? So you can see why I might've had that alerted, not to mention the grouping. So I know off the top of my head, just from experience, I know consumer education, you probably know too, you've been at it long enough, whether it's, not RFU, but EDU is another one. The group has been doing okay, TAL. So so what I'll do is I don't have alerts on these, but I'll keep alerts nice and tight on them. Sometimes I'll keep them high and low. And while these things are going off all day, I know, okay, education stocks were leading and now they're breaking their 50 days, or hey, they're tightening up and they look like they're under accumulation and maybe that's where money's going next, sort of thing.
Very interesting.
So that's how I use China, right? So I will go through it all. And let's say I feel like I've gotten the most dominant. Let's say I'm in the 70s on relative strength. I'll sometimes just go current price. We know that a lot of times in the stock market, you get what you pay for. Sometimes you get thin, garbagey, expensive ones, but as you can see, a lot of times what you wind up getting is the higher priced, high quality ones. So this is just another way I like to go through it. And you can see, this is where you're getting your bigger cap. Obviously, so there's one of your more garbagey, thinner, expensive ones. Prior to that, here, let's go back one. What is it? So for example, this is a high priced stock, but still relatively thin. 59,000 shares today. You want nothing to do with that. So DQ Solar, as I'm sure you know, was a hot group. Well, so this is significant to me. So as I'm going through, not just Chinese solar, and again, you can see it's got the earnings and sales down here are enormous. So, without going through them all now. And then a lot of times what I'll do, let's see. So maybe I go through and I see that the solars are breaking down. So I'll make a note of that. That was a big leading group. I want to know. So if I see solars breaking 50 days and I'm seeing the education stocks breaking their 50 days, and these are stocks that have had, that have doubled, tripled or more. And I mean, I don't care if their earnings are huge, because there's that saying, we buy on fundamentals and technicals, but we sell only on technicals. And the reason is the earnings will often look, you can see triple digit growth for 6 to 8 quarters after the stock is topped and fallen apart to the tune of 70, 80%. So when I see, so that's what I'm looking for. So that'll be what I'm looking for tonight. Are we seeing groups really start to, break important levels? Is it time to further back away if you weren't all the way out of the way today? Or where is that accumulation? And a lot of times, we might see a half a dozen of these solar stocks breaking and it may just be a shake below the 50-day before they build. Before they build the new base and ultimately be okay. So that's why I'm just constantly on top of resetting alerts, paying attention to where the leading stocks are, and are stocks breaking, setting up? Are we under distribution? Are we under? Because if you have that running in your head, are more groups under accumulation? Does it look like, ooh, these things look like they're setting up as this gets extended over here? Or does it look like all of a sudden everything's breaking down and there's nothing to buy?
And Ross, let me ask you this. I know from your posts on TraderLion and everything you talk about on Twitter, relative strength and the relative strength line is very important for you. So do you take a look at, as it's breaking through the 50-day, that the RS line is basically going vertical downward? Do you take that into account when you're looking at rotation?
Here's what I would show you. So here, just price relative to the relatives, hence relative strength line. So here you go on that gap. Let's say if you go to the relative strength line, roughly where it is there, and draw, you can see that this relative strength line was making new lows before that price. I'm going to bet, right? You can see you had the relative strength line making new lows probably yesterday. So that's it. And not always is it going to do so. I don't really play it on the downside, but that's how it works on the upside. So if we were to see the market settle down and stocks start to set up a constructive bases and appear to be under accumulation, if I start to see the relative strength line peak up to new highs ahead of a price in a constructive base, I'm going to tell you I've just noticed that is a sign. I don't know what the percentage is, but it's a high chance that stock's going to break out. Now, is it going to break out and work, or is it going to be, what I've noticed is this has become a common theme: breakout, fail, and break out again, sometimes a third time. And the most frustrating part about it is it'll break out on volume, it'll come back in, there's not real, and it never sets off a sell stop. And then on that second breakout, after you're sick of it, it just looks ugly now. It just see you later. So
there it goes.
Yeah, right. So I've kept, anyway, that goes along with personality of the stock. In my mind, I think I tend to like to buy the tighter, smoother moving, more liquid ones than the ones that whip all over the place. That, those you've got to buy on weakness and be more patient with. I do it, but it's not, I can do it, but it's not my style really.
And I think it's a key thing that you've talked about, and especially in your videos on TraderLion, that you're looking for these divergences between the price and the relative strength line. And I think a good example is if we bring up BIGC before its big breakout from its IPO base, the RS line was breaking out to new all-time highs before the price breakout from that IPO base, and you could have had a nice gainer on that if you were ready.
Absolutely. That was actually one of those ones, honestly, I was aware of the IPO. I hadn't been paying attention to it that day, but I had a basic alert on it, and it just, my alert went off. I looked at the volume when, you know, it had, and I bought it before the breakout, that, and it, you know, I told you I got less, but I sold a third of it above 140, and I sold the rest of it in the 1-teens. So I made money, not anywhere near as much as I could, but yes, I mean, you know, I guess it was kind of stupid. I mean, 50% in a couple of days, I probably should have taken off more than a third. But yes, that was the old, if I see the big volume, the relative strength, and an IPO U-turn to boot, and the relative strength lines making new highs ahead of the price, that's one of those things. Like a lot of times, as long, you know, I'll take it down to the intraday and see where support resistance is. But I'll tell you, there are times when I see a situation like that where I really feel like I have some serious edge, where I'll just put it on like that. And what's my sell stop? My sell stop will be, if it doesn't immediately work, I'm done. I just sell it, and I'll revisit, re-examine, and come back to it. And that was one of those ones. I'll tell you, I just happened to catch the alert. The volume was there. I bought a chunk, and it just took off. Doesn't always work that way. So, but then again, here you go. So here's your are we going to re-break out? I have no idea. I mean, is it going to fall apart? It wouldn't surprise me to see it fall apart, but it also wouldn't surprise me to see it ultimately work on building a new base and being okay.
Yeah, so you have to be quick with the IPOs.
Yeah, my problem with it is this: I know nothing about it, but I look at Shop. I know it's competition. I look at Shop's earnings. I look at the earnings here, and there's no comparison on that in that regard. Not to mention, you know. So we'll see what happens. I'm always very super liquid, high-priced IPOs usually work out well, but not always. So, but this one still isn't complete. It's ugly today, but that a lot of that has to do with the general market. So it's worth. I'll be drawing an alert like this. I don't care if it goes lower. I'm not interested lower. But if it continues to, break that alert higher tomorrow over the next few days, I keep resetting it, and that way I never lose track of what BIGC is doing if I want to try and buy a re-breakout if that happens, which has actually been a very the re-breakout, what is that? I don't know, but it works. It's been working. That's just an observation. I haven't done a study on it, but I've been buying them, and I've also had the patience to buy the first breakout, sit through the comeback in. If you notice, a lot of times, so here's what you got to, I think a lot of people forget. I mean, there's two reasons for and I digress, but it's still good information. When Bill did the study did his studies, when you're buying a stock out of an early stage base and it possesses all of the can slim characteristics, not only does a 7 or 8% sell stop, if you, I have the graphic somewhere, I can show it to you, you can be wrong 3 times for 7% in a row. And as long as you're right for whatever, you can be wrong. You've seen it. It doesn't matter. And you're in good shape. So that's the first reason. It keeps you from getting too far out of control. But the other bigger reason is, like I said, when you're breaking out of an early stage base and all of the can slim stuff is there, maybe it's 7 or 8 times out of 10, that breakout should never fall more, should never pull back that 7 or 8%. So, and I'm going to tell you, I've been watching them, not in every, but in many of these cases now, I'm going back. So they break out, even if they fail twice and break out a third time, not just a second time, they never tick that 7%. So if you buy them, even if you're patient with them, I'm going to say a majority of the time they've been working, which is not, it used to be where I'd buy a stock if it failed, or even before it failed, I just got the heck out of the way and moved on to something else. But that hasn't necessarily been the case for a while now. So
I know the best breakouts that I bought this year. Tesla, they work right away, and they have follow-on days on volume, following up the breakout. So let's go back to Tesla, because actually that's a good example of both the relative strength line hitting a new high before the breakout, and also just one that works right away and just keeps going up. So the first breakout from that 205.50 pivot, the previous breakout, actually, the right around 205.
Oh, back to, yeah.
The RS line made a slight new high right before that breakout. That was the trigger for me to buy that breakout. And I mean, this has been one of the model book stocks of 2020, in my opinion, at least.
Oh, for sure. This is absolutely, this to me, for me, they would had been, if I picked at the beginning of the year with Ray, Tesla and ZM, Tesla, just because it's one of those weird ones. It would go in my model book, but maybe not Bill's. I've got some exceptions that, that I've made for certain things that might not necessarily, and so have that. Don't get me wrong, they're not missing Tesla over there. That's for sure. This wasn't a hard one to make. It's usually the biotechs that I'll make it, the exceptions for that will. But yes, the relative strength on here was clear. If I'm not mistaken, if we go all the way back to, I mean, you've had it almost making new highs here versus here. Mm-hmm. So, I mean, you had the relative strength literally, in new high ground starting here. And it was up, kind of the entire time. I mean, even before, are you with me there? So you have the strength line above this high. If you want to go, the relative strength line was above that while it was base building for a while. So to me, that build up in relative strength was going for a while. So it's not surprising that as it was explosive as it was when it finally got going.
For sure.
So that thing was up there for a while. I was staring at it. So yeah, Tesla was kind to me both times. I got a hold of both breakouts.
So why don't you walk through the couple other screens you've got going on, especially if you got one in particular that you really like?
Where Wanda and MarketSmith differ the biggest is in the screening. Okay, the screening capabilities on Wanda is phenomenal. However, for me, unnecessary. Wanda has the same exact canned screen. Everybody has this screen up on volume. I find almost all of I still rep Portfolio Manager screen. I'd be happy to share with everyone. This is one that a buddy of mine shared with me. Who I have he used to be a client of mine when I was in institutional sales. So we still stay in touch, and that's a screen he shared with me. He uses MarketSmith now because you don't need one. Wanda is not necessary if you don't have soft dollars paying for Wanda. There's no need to. Nice charts. I want to say might even just be a list. I don't even know that that's a screen. But anyway, up on volume's my favorite. Honestly, everyone has it. Ask Ray how many times I tell him about it. And it's amazing. I watch people build all their fancy screens, and I run this screen. And after 3 hours, I've run all my screens. Honestly, I think you can open up the up on volume screen. Obviously, today's not a day for the up on volume screen. Today was a rough day. But again, I'm always going back to relative strength, and I just start at the top and space bar my way through. And I do, whatever this is. And so maybe, this is a lower price. It's actually pretty liquid, but this is it's one of these blank check companies. There's been a ton of these. So it's high risk. You can see it. There's no earnings, all of a sudden volumes coming in out of nowhere. It used to I guess, it had its days where it did enough volume. So if I was in a rock star market, I would set this alert right here. Maybe if I had alerts, and if I caught that alert going through and I had some extra money and the volume was there and I thought I could, but that's not my typical thing. I'll mark this one for fun because I want to see it. But no, and then I continue on. When I see that pattern, so it's that sort of pattern that's going to catch my eye. I'm immediately going to look, what group are we in? Remember, we come over here, what is our group rank? A lot of times, if I'm not sure, it makes it very easy. You go to the weekly chart, you can see the top 5 relative strength stocks in any group. That's a big O'Neill thing. A stock sector and industry group has, I want to say, just under a 49%. Direct correlation is the word I'm looking for. So anyway, and that's it. So here's our up on volume screen, and you can look through. We've got some household furniture, got a little biotech stock. Just by looking at the way this is trading, I'm going to tell you that this is something that's probably being taken out. It's not unusual to see it, so that's not interesting to me. But I would just tab through like this, looking at patterns. Here we go, another blank check company. So obviously I'm going to keep an eye on that. I'll tell you why, because I've heard Mike Webster tell me that IPO U-turns are the most successful, bases of the bunch. And so I go, so here's how I might think if I wanted a swing trade or something. Now, this isn't something you really want to be doing when the market's falling apart, but when the market's in good shape, if I saw something like this, and I know, we just saw a blank check company doing the similar pattern. We've got it liquid. I'm going to watch those two now. I might make a little basket of blank check companies, but it's the kind of thing where I'm going to pick a spot and I'm going to pick my spot, and I'm going to pick a super tight stop. It's not something that I'm going to sit with or give any room. It doesn't have the earnings. It doesn't have the sponsorship. That's the whole idea also behind having the high quality stuff is, it's nice when the big boys come in and save you, which doesn't tend to happen with some of the cheaper garbage. So, and that's it. So, up on volume, we're going right through. Here we go. VIPs. Here's another Chinese stock, big outside day at its 200-day moving average. Worth keeping it, So, and this is my process, and it's amazing. To be quite honest with you, as I'm going through here, I'm seeing here, here we go, another biotech. So you're seeing strength in some stocks, trucks, heavy duty parts. I'm not really, it's not the kind of thing that I typically look for and consider super growthy, but see, Shoe Carnival isn't the end of the world. Stuff, these retail stocks can here we go, another blank check company, that same sort of pattern. And so here we go. REITs have been, so REITs, I think, I hear people talking about them as defensive, but I'll tell you now, they're not. All you have to do is look through the group. They've got huge growth. They're super liquid. This pattern catches my eye. So what would I do? I wouldn't do it for you now. I'll write down REITs, and I would go through view stocks and industry. Look, there's 183 of them. And so to be quite honest with you, so here's what I do is I run this screen, and I do the same thing as I do with the any of the screens. I'll run them by relative strength. When I get down into the lower relative strength, and this screen doesn't really count because you only got 95 stocks on there, but a lot of times there's hundreds and hundreds, and you can't go through them all. I'll then go back and sort them by whatever you want. Maybe you just want to look and see what did big volume for the day, or all the big, but my big two is I sort by relative strength rating, and then I like what relative strength rating, and by current price, most expensive first, just because I like to see the expensive stocks. Those are often, your big institutional, and I'll get an idea. I'll go, oh, okay, so REI, I'll look through and see, looks like money is rotating toward REITs or not. Maybe that'll be a group I wind up with a bunch of. So I let this one be my guide, and then I spend a lot of time opening up. I'll find a group that's interesting to me, and I'll click view stocks and industry, and here, same sort of thing. So here's all 183 stocks in the REIT group. We can sort these by relative strength. And again, so this would be a whole nother group. And I'm going to tell you more than likely, so there's a low priced garbage one. You'll see big earnings coming through here, stocks that are holding up well. This is actually a marijuana stock, if I'm not mistaken, in particular. Yeah. But and that's my process. So I can't tell you, I've been living on that up on volume screen since Wanda. I'll go through, I maybe run these once or the rest of them maybe once or twice a week. I'm stuck on up on volume. I feel like now you can, I feel like people build all these. To me, you want to build screens if it's going to save you time, save you from having to tab through a bunch of garbagey stocks. But for me, I would rather pull up all the stocks that moved on volume. And I find for me, it's faster to just screen through. And I like to see what didn't work with my eye. And it's tedious, but it works for me. So, and I mean, really, I let this is my main screen that guides me, the up on volume by relative strength and by price. And then as I'm setting alerts and, trying to pay attention to where the rotation is. If I see a group that, I'll always start by, let's go to the weekly and see the top 5 relative strength stocks in the group. If I want to see more, it's a big group, I'll tab through the group. And that's how I have a constant feel for which groups are doing what, because honestly, those are the ones I run the next most up after up on volume while I'm keeping track of rotation. I'm constantly sorting through the leading groups in the same way by relative strength and the highest price, because I like to keep that like permanently in my brain, like an imprint of exactly, a map, that the heat map, but the way I, not in red and green, but the way I've ingrained it into my head. I've definitely got some synapses wired hardcore, doing it this way. After a while, not even worth changing for me. I'll do it this way till I die.
And Ross, you keep track of so many stocks, and just to summarize your process, you're going through your screens, you're setting alerts throughout the day, you're seeing what's kind of working, what's increasing. How many stocks do you actually trade within your portfolio? Because you're keeping track of dozens, even hundreds of stocks. How many are you actually trading actively?
Very few, actually. I'd say now that with the there's been a huge increase in volatility, for at least in my experience. I used to like to get super concentrated, have maybe 160 to 180% of my portfolio in 2 or 3 stocks, and then maybe I'd swing the balance around, and then I would also trade of my core positions. I would trade around the edges on those 2 and 3. They would be so maybe a Tesla, ZM, and whatever. I would at buy points where I thought risk reward was great and I had a lot of edge, I will tend to overbuy and then sell stuff as it gets extended, just to, continually lower my average. However, with all of this volatility, I was getting shaken out like crazy for a while there. So what I've done, I actually picked this one up listening to Mike Webster the other day, and I've always tried not to get too spread out, but I heard, it made sense to me, spread it out into 6 or 8 stocks. And that has been my sweet spot really right now. I'm typically long somewhere between 6 or 8. If I can keep it to 5 or 6, fewer is better for me. It's what I'm used to. Mm-hmm. Once I'm out to, every once in a while, when the market, you're just like, woohoo, I don't have enough money. Everything looks good. And there are those times where I'll get out to maybe 11 or 12 stocks, but very rarely do I go home with that many stocks, unless there's just, the only thing keeping me from owning more of the same or buying something else is I don't have enough, I don't have enough money to buy more. And those times come. But in general, again, this would be the other thing. It's not about stock picking. I think you can learn to spot setups, and stock picking isn't the hard part. It's managing your emotions and understanding position sizing, risk management. Everyone's going to do it a little bit differently. Everyone's going to get be a little greedier than someone else, or a little more fearful than someone else. And it's a lot of that is, they say half art, half science. A lot of it is, getting a feel for things. I'll tell you what, I don't know a single trader out there, a portfolio manager out there that doesn't get out of shape and have a tough time for a few weeks. Whatever it is, trust me, Bill O'Neill doesn't go through life without having a tough time trading here and there. He has his tough spots and he gets pissed off. However, what you do is you cut your losses and you take a deep breath and you keep your head out of your butt and you stay positive, and you just I've watched what he does. He'll just listen, let's not be more than 20 or 30% invested until we start, making some real progress. And that you'll always repeat me. So let's say you're going from cash and getting long again, maybe you put on 3 or 4 positions of 7 to 10% a piece. If you're not making progress on those, you have no right to be buying more. And I know the temptation is, oh, well, maybe if I just buy 1 or 2 more breakouts, it'll make up for these until they bounce or whatever it is. Trust me, I've been there. I've tried it all. I have personal rules. I have my rules for breaking rules, but in general, don't average down, especially when you're just, getting long from cash. If your first 3 or 4 positions aren't working for you, you need to follow stops, not add more, and then restart, whether it's the same, something's not working at that point. So, and that's what I'll do. So anytime I run into, whenever I run into a wall, I start, spinning my wheels. It's immediately what I do, get myself down to I can breathe and sleep again. Like Bill says, sell down to the sleeping point, or like everyone's, that's a pretty common saying. And I will buy sometime, and if I'm in a bad rut or, things are crazy at home, whatever, things get crazy in life, and I'll just back away and keep it small to an irrelevant amount and you'd be surprised. It's hard at first, and to just buy maybe a couple hundred shares of something or 100, whatever it is. But that's the whole idea, is to buy something that you can walk away from your screen for an hour and you're not worried what's going to happen. So you're going to let it breathe. You're going to let your stops work for you. You're not going to be overly panicked on top of it. So that is another. So I digress again. It is about the stock picking to an extent, but it's really about understanding that risk management and position sizing and getting a feel. For how that all works, how big you want to start a position, how quickly you're making progress. But for sure, if you're not making progress once you get started, the idea, either wait till you're making progress if your stocks haven't stopped you out, but definitely don't keep trying to buy stocks if the first 3 or 4 you bought aren't working.